Welcome back everyone. In this video, I'm going to be going over some uncommon dividend ETFs. It is great to speak about the popular ETFs like SCHD and JEPI, but I do want to give you some examples of some uncommon dividend ETFs just to show you what is out there. And these ETFs are pretty much not even a fifth of the size of an ETF like SCHD. They're really not spoken about that much, and they're relatively unknown in themselves. So we're going to be going over those and kind of going over the pluses and minuses of them. And if you do enjoy this video, definitely please give it a like and subscribe for future content. And the first ETF on this list is the First Trust NASDAQ Technology Dividend Index Fund. And in the dividend world, this ETF has a pretty uncommon investment methodology as the fund seeks to track technology companies that pay dividends. So people that enjoy technology and are tech investors might like this ETF if they also want some dividends to go along with that. Now, this ETF basically selects stocks from the NASDAQ, and they must be technology or a telecommunications company. And they also must be relatively big with a minimum market cap of 500 million. And there are some additional investment criteria below. But basically, the main idea here is that they must be a technology or telecommunications company, and they must be listed on a NASDAQ, and they also have to pay a dividend too. Looking at the top 10, you have some very well-known tech companies at the top here. We have Broadcom at the top, and Qualcomm. IBM is a very popular technology company that does pay dividends. Microsoft, Texas Instruments, and so on. So as you can see, some very quality tech companies in the top 10 overall. Of course, IBM had a bad few years for a while, but it did come back a bit. Overall, though, these companies are all quality companies, and the investment objective is to select them so they pay you dividends. And while this ETF does have 84 holdings, we are going to see that the majority of this ETF, around 40% plus, is going to have the majority of its holdings in the top 10 of its stocks. And looking at the yield, we aren't going to expect much from this, as technology companies generally don't pay high dividends because they reinvest all of their cash to grow further. But the yield that we see is about 1.64% currently. When it comes to dividend growth, this ETF does have some pretty sporadic growth with pretty much a lot of ups and downs. So when it comes to dividend investing, if you are buying this ETF, whether it be for the dividend growth or dividend yield, this probably isn't going to be the ETF for you. It is going to be primarily for tech investors that do want those more well-established tech companies that also happen to pay dividends as well. And doing a bit of back test here for about 10 years, from January 2013 to January 2024, what I did was I put this ETF up against three other popular investments. We have SCHD, VOO, and QQQ, and I just did that to see how this performed over time. And what we see is this actually did outperform both SCHD and VOO. And it outperformed SCHD by quite a bit, and that is because technology has grown quite a bit over the past few years, and of course we see that in QQQ with it growing the most. So when it comes to growth, I would say that TDIV, the First Trust NASDAQ Technology Dividend ETF, isn't a bad ETF, but of course, if you just want to primarily invest into technology, you probably should just go with QQQ, as TDIV doesn't pay that great of a dividend, and it also doesn't really perform that well compared to a fund that really does track technology as a whole. You're still going to outperform if technology does well, things like VOO and SCHD. But again, you're really only exposed to one sector with TDIV, and if you want to be exposed to technology, why not go with QQQ? And that also does pay a dividend, even though it is smaller. You're going to probably get more growth over time. And on top of that, with TDIV's expense ratio sitting about 0.5%, it really doesn't have any benefit for that added price tag. But it's definitely a different kind of investment style when it comes to dividend ETFs. Next up is the ETF NOBL, or NOBL. It tracks the S&P 500 Dividend Aristocrats Index, and the only ETF out there focusing on the S&P 500 Dividend Aristocrats that have paid dividends and have grown their dividends for at least 25 consecutive years, with most growing them for 40 years or more. So this is really starting to invest in those dividend companies you really want to invest in. All of these companies are pretty much well known, and we're going to get to those holdings. Unlike the last ETF, all of these companies do vary pretty well based on industry, with consumer staples being the top one and industrials trailing not far behind. So this is going to be a more conservative kind of investment style. Most of these companies are all well established, and you're not really going to see huge swings. As you can see, technology, unlike the last ETF, is all the way down at the bottom. And you're going to see things like consumer discretionary also down at the bottom. Things that really are impacted by a falling economy all at the bottom generally, while things that are more defensive like consumer staples are at the top. Overall, this ETF has some really good diversification, with none of these holdings really outweighing the other by too much. They are in a narrow weighting band here, with no holding again significantly more than the other. And again, you probably know a lot of these companies on the list, as these companies have been paying consecutive growing dividends for at least 25 years. All of these companies have been around for a very long time, and they have weathered pretty much every single economic downturn in the last 25 years, and they're all still around. Some aren't really growing that much, and others are growing pretty well. All in all, a very decent list of quality dividend paying companies that have a record of growing their dividends. This one has a trailing 12-month yield of around 2%. And the expense ratio isn't as bad as the other one for what it tracks. Again, this is the only real ETF that does this, at about 0.35%. And this ETF has an average 5-year dividend growth rate of almost 7%. So you are going to get that dividend growth over time, unlike the last ETF. However, the dividend growth is somewhat sporadic, with ups and downs over time. So don't expect it to always be increasing. It's just that some years have blowout years where there's massive dividend increases, and expect every so often a year to not do so well. Getting into the back test, I paired it up against SCHD and VOO, and we see that this ETF underperformed SCHD by a bit, and it underperformed VOO by quite a bit. These dividend aristocrats really aren't known for their growth. They're just known for consistent, generally increasing dividends over time. So the main problem with this ETF is that if you're looking for dividends, why not just go with SCHD? It pays a higher dividend, and it also grows more over time. So this ETF, as good as it sounds on paper, investing into all of these dividend companies that increased over time, when you really look at it, it doesn't really do all that well compared to the popular dividend ETF SCHD. And finally, we have DGRW. Now, this kind of sounds like DGRO, DGRO. That is a pretty popular dividend ETF. This ETF is not that. This ETF is the Wisdom Tree US Quality Dividend Growth Fund, and it basically tracks a dividend index which kind of tries to emulate SCHD almost. This ETF invests in larger companies with a market capitalization of at least $2 billion, and it comprises an index of 300 companies, and then it ranks them based on some long-term earnings growth expectations and various other factors. So remember how SCHD invests in companies with a record of growing dividends and then runs them through financial ratios to pick the best of the best. this kind of tries to do the same with just a different set of criteria. This ETF does invest in a quality list of companies, although it is a little bit top heavy with a large number of the total value of the fund in the top 10. And it is also weighted pretty substantially to information technology. So if you do go about investing in this ETF, just keep that in mind. You are going to be exposed to information technology. However, there is a good number of other industries that kind of weight it out too. This ETF has a trailing 12-month yield-seeking alpha says of 1.68%, so it is really not that much, of course, as we'd expect because of that weighting toward information technology. The expense ratio is the lowest on this list, which is funny because this is the best ETF on this list. It's under 0.3%. Pretty modest growth overall with a 5-year growth rate of 4.86%. And we are going to see that dividend growth does jump around quite a bit, with some years it not going up at all. It's remaining relatively flat or going down, but some years going up really high. And here we have the final back test. Again, 10-year back test, it going against VOO and SCHD. And what we do see is that this ETF did outperform SCHD by a good margin, and it also slightly underperformed the S&P 500, and it also did have the lowest standard deviation of both of these ETFs. Now, this is a dividend growth ETF, so what I want to do is pit it up against an ETF that's designed to grow its dividends, like the Vanguard Dividend Appreciation ETF. Now, this ETF still did outperform the Vanguard Dividend Appreciation ETF by a good amount. Now, looking at this ETF, it doesn't seem all that bad, but if you do really think about the dividend it provides, is this really even worth it? Is this even really a dividend ETF, or did they just throw that on there? Because if we look at the dividend growth of VIG, you see that it completely outperforms DGRW by a good amount. And even the dividend growth of the S&P 500 is pretty much in line with DGRW. So again, kind of pointless to call it a dividend or dividend growth fund, honestly. So at the conclusion of this video, would I invest in these ETFs? And the answer is no, I wouldn't. They don't perform that well, and they don't even really conform to an investment objective. We have other ETFs like SCHD, VIG that basically perform more in line with the investment objective and basically provide a better dividend with similar growth. Some of these ETFs like TDIV are very reliant on a single industry. And if you want technology, again, you could go with QQQ. The dividend aristocrats are good, but if we're looking for those growing companies, we can pick an ETF like SCHD or VIG that outperform in dividend growth. And the last one, DGRW, doesn't even really provide a dividend that grows more than the S&P 500, and its dividend is pretty weak. The intent of the video was just to kind of show you some different ETFs that are out there, and to basically also show that the popular ETFs are probably popular for a reason. And I'll probably do another video like this in the future going over another 3 ETFs. Again, if you did enjoy the content, drop this video a like and subscribe for future content, and I'll see you all in the next video.